If you think we're in a stock market bubble simply because you're seeing stocks like IonQ trading at $22.8 billion in market cap with only $52 million in revenue, and you're seeing stocks like Oklo trading at $20 billion in market cap, up 100% in the last month alone with literally $0 in revenue, and finally, you're seeing stocks like Palantir leading the charge, one of the biggest companies in the entire market, trading at 125 times annual revenue, then you're probably right. We are in a stock market bubble. But before you go out and sell out of all of your stocks in anticipation of a stock market crash, I want you to keep in mind that things can get a lot higher from here before the bubble actually pops. And I want to take you back just a few years ago to 2021, which was when we had our last stock market bubble. And we saw companies like Rivian Automotive trading at $150 billion in market cap with only $55 million in revenue. And we saw companies like Lucid trading at $90 billion in market cap with only $27 million in revenue. And to make things even worse, we saw people buying real estate in the metaverse for the price of a penthouse in Miami. I mean, literally, we saw people buying virtual real estate that is literally worth nothing for $4.3 million. And to make things even worse, as if this was possible, we saw people buying NFTs, which are virtual JPEGs, for $60 and $70 million. So yes, the stock market is getting frothy, but instead of selling out of all of my stocks, what I'm doing instead is I'm rotating some of my profits from the high growth, high beta tech stocks, and I'm rotating it into stocks that are not tied to the index, stocks that are not technology stocks like AI, quantum, and robotics, and stocks that are recession resilient. And so in this video, I'm going to be talking about the top 3 stocks to buy to protect your portfolio from massive downside risk. And the first stock on this list is Brookfield Corporation, ticker symbol BN. And Brookfield operates in 3 different segments. The first one is asset management. The second one is wealth solutions, which is basically their insurance business. And the third one is their operating business, which is basically their real estate and their infrastructure business. So what we'll do is we'll break down each of these segments and then we'll run some numbers and finally we'll talk about their valuation. So like I said, the first segment is their asset management segment, and how this works is essentially they pool money from investors like college funds, pension funds, and endowment funds. They take all this money and then they invest it into alternative assets like infrastructure, renewable energy, private equity, real estate, and opportunistic credit. And how they make money is they essentially charge these investors, like all of these college funds and the pension funds, etc. They charge them a management fee, so 1%, 1.5%, 2%. So whether these investments play out well or not, Brookfield is collecting money hand over fist because, again, they're collecting management fees whether these investments play out well or not. Now, that's the first part of how they make money, the asset management segment. But the second part, which is a smaller part of the asset management arm, is if they meet and exceed their targets. So, like, for example, for infrastructure, they target for 13% returns per year, and they actually ended up returning 15% returns per year. So if they meet and exceed their targets, they end up getting a commission. So not only are they collecting management fees, they also collect commission fees if they do end up meeting and exceeding their targets, which historically, as we can see from this slide, they have done very well. So for infrastructure, like I said, they targeted 13%, they got 15%. For renewable energy, for example, 14% target, 17% actual. For opportunistic credit, for example, 15% target, 22% actual over the last 37 years. So this slide on its own shows us that Brookfield has been able to deploy capital at super high rates of return, and they've historically been able to meet and exceed their targets. So that's the first very important thing when it comes to asset management, is making sure that historically they've been able to deploy capital at super high rates of return. Now, the second thing to look at when you're investing in an asset management company is that management is super incentivized with shareholders. And Brookfield does that and they talk about it here, so 90% of senior management's wealth is concentrated in Brookfield. That means that it's pretty self-explanatory. The performance of Brookfield stock is heavily tied to senior management's wealth. And 20% of Brookfield Corporation and Brookfield Asset Management are owned by senior management, so super high insider ownership, and their team continues to buy more shares in the company. So this just goes to show that management is super incentivized and super aligned with shareholders, which is exactly what you want to see with an asset management company. And so what they're guiding for over the next 5 years is 18% growth in distributable earnings per share. And so instead of using PE and EPS and net income, a company like Brookfield, which is an asset manager, uses distributable earnings per share. And so they're guiding for distributable earnings per share to grow at 18% over the next 5 years. And now the second segment, like I said, is the insurance segment. And this segment is expected to grow from $110 billion today to $300 billion in 5 years. which is almost a 3x in 5 years, which is very insane. They're heavily doubling down on this insurance business because it's one of their fastest growing segments. And finally, the last segment, which is their operating business, which they invest in infrastructure and real estate. And so what they used to do is they used to invest in things like railroads, ports, hydro, pipelines. But now, since all of these industries are getting disrupted, they're now investing in telecom towers, data centers, solar, nuclear, logistics, hospitality. And now the only part I don't like about Brookfield is their real estate portfolio. And they have around $30 billion or $25 billion in real estate. And a lot of this real estate has become unprofitable because interest rates have been so high. Now, the good news is, number one, rates are expected to drop, which should help with profitability on this real estate portfolio. But number two, which is the part I really like, is that they're selling down a lot of this real estate because they're noticing that, hey, this real estate is not so profitable. This is our lowest quality segment. So let's sell off all of these assets and reinvest the company into their insurance business and their asset management business, which is exactly what you want to see from management. You don't want to see them doubling down on a segment that's not performing well. You want to see them pivoting when they see that a segment is not performing well, which is exactly what they're doing with their real estate portfolio. And we can see this, that over the next 5 years, they're expecting their operating business right here, which is their real estate and their infrastructure portfolio, to only make up a small amount of their total free cash flow. And the lion's share will be made up of the asset management business, which is the dark blue and light blue over here, and their wealth solution business, which is the insurance, also make up approximately 30 or 40% of the business. So once again, this is showing us that they're not doubling down on their bad real estate portfolio, but instead they're selling off those assets and reinvesting them into the asset management segment and the insurance segment. And so if we put this all together, the company is guiding for 17% growth in distributable earnings per share from now until 2030 on the very low end. And if they include capital allocations and realizations, which is basically their commission, in addition to any buybacks they might do, on the higher end of their guidance, they're expecting 25% growth in distributable earnings per share from now until 2030, which is absolutely insane. So again, on the low end, before any share buybacks, before any commissions that they earn on their investments, they're expecting 17%. And on the higher end, which is, I would say, best case scenario, they're expecting 25% CAGR when it comes to distributable earnings per share. And so if we run that into our valuation model, so $3.16 in EPS and 17% growth per year. So right here, $3.16 and 17% growth. So I'm not even gonna run the best case scenario. I'm just gonna use the base case scenario. So once again, $3.16 in EPS and 17% growth per year from now until 2030. And I'm expecting the multiple to stay the same, even though I think a company like Brookfield deserves better than a 22 times earnings ratio. But even including these super conservative assumptions, we can expect a company like Brookfield to return 16% per year to investors from now until 2030, which is exactly why I think Brookfield, despite it trading at all-time highs, is still one of the best stocks to buy today in 2025. And so the second stock on this list is Texas Pacific Land, ticker symbol TPL, and this stock is down 50% from its all-time highs. And we can tell that historically, this is when the stock tends to bottom, at around 50% drawdowns, except for twice. During the financial crisis in 2007, it was down around 70%, and during COVID, it was down around 65%. So aside from major stock market crashes, the stock typically tends to bottom at around 50% drawdowns, which is where we're at today. And now I'm going to quickly talk about what TPL does, how they make money, and why I think the stock is a good stock to buy today. So TPL owns 887,000 acres of land in the Permian Basin, which is the western part of Texas. And the reason why the Permian is so important is because it's one of the largest oil producing regions in the entire world. So this region alone produces more oil than the entire country of Iraq, and it's up there with entire countries like Russia and Saudi Arabia. So this is exactly why TPL owns so much land in this area specifically. And so now we'll quickly talk about their different segments and how this company makes money. So the first segment is oil and gas royalties, and this makes up 53% of their revenue, so the lion's share of their revenue. And just to keep in mind, like 5-10 years ago, this company was only collecting money from oil and gas royalties, but they've since diversified away to all these other segments, which is something we'll talk about later. But first, let's talk about the oil and gas royalties segment, which again makes up 53% of their revenue. So instead of actually doing the drilling themselves, what TPL does is they allow companies like Exxon, like Chevron, like Occidental Petroleum to drill oil on their own land, and they don't take any risk. They don't have to do any investments. They don't do anything with the job site. All they do is they sit back and they collect royalties from these companies by allowing them to drill oil on their own land. So this is the very first segment. Pretty self-explanatory. And TPL's second segment is SLEM, which is surface leases, easements, and material, which only makes up about 10% of their revenue, so it is the smallest part of their business. And what SLEM is essentially them investing into pipelines, solar, wind. So essentially they're investing into infrastructure on their land that helps the businesses that operate on their land to do their operations more easily. And a lot of their agreements with these companies for the infrastructure that they've built are 10-year contracts. And now the third segment is water sales, which is really where this company starts to get super interesting, because it makes up 21% of their revenues, and then water royalties makes up 15% of their revenues. So water as a whole makes up about 36% of their revenues. And just 5-6 years ago, again, remember, this company was primarily an oil and gas company, but since then, they've heavily diversified away from just oil and gas, and now they're really starting to double down on their water business. And I'll show you why in just a second. So as we can see here, since 2017, the company has basically 20x'd their water sales volume, which really goes to show how much they're focusing on this water segment, because it's such a cash flowing machine. And so I'm going to try to quickly explain why water is such an essential part of TPL's business. So when it comes to companies like Exxon and Chevron, when it comes to them drilling oil and drilling down for oil on TPL's land, they need a massive amount of water. And this process is called fracking. So fracking is basically the process of drilling down and then using super high pressure water along with other chemicals to break down the rocks underground so that they can extract the oil. So essentially, this process of fracking needs a massive amount of water. And instead of these companies like Chevron and Exxon having to bring trucks of water so that they can do the fracking, instead, they just buy the water from TPL. And what TPL does is that they pump water from underground and they sell it to these companies like Chevron and Exxon. Now, the second part of their water segment, let's call it, is their water royalties. And this works in different ways. So essentially, how this works is when these companies like Chevron and Exxon drill for oil, it's not just pure oil that comes out. Oil comes out along with a bunch of salty, dirty water. And so instead of, because they can't just dump it on TPL's land, what they need to do is they need to hire a third-party company to take that oil and dispose of it by dumping it back into TPL's land. So the third-party company charges Chevron and Exxon to dispose of the water, and TPL charges the third-party company royalties because they're doing all of this on TPL's land. And because the company has moved away from solely relying on oil and gas royalties and diversified, like I said, to SLEM, water sales, and water royalties, even though the price of oil has dropped from $81 a barrel to $64 a barrel, TPL has actually been able to grow revenues at 9% a year. So I want you to keep that in mind. Even though the price of oil has been plummeting over the last year, TPL was still able to grow their revenues. And now 3-4 years ago, this was not possible. 3-4 years ago, if the price of oil dropped this hard, TPL's revenue growth would have been negative. But because they've diversified away from just relying on oil and gas, and now they're in SLEM and more importantly water sales and water royalties, the company was able to grow revenue at 9% year over year. And so now we can expect that as the price of oil starts to recover back to $70 and $80 per barrel, we can expect TPL's revenue to literally explode, because not only would they be experiencing growth from their water segment, but they would also be experiencing massive growth from their oil and gas royalty segment, which would benefit massively from the price of oil increasing. And something super interesting that TPL is working on is a desalination facility that's expected to launch in 2027. And what this facility allows them to do is to reuse and recycle the dirty water that comes out of fracking. So instead of having to hire a third-party company to dispose that water and dump it back into TPL's land, this desalination facility will allow them to take that dirty water, clean it, and resell it back to the fracking companies like Exxon and Chevron. And it allows them to sell it to companies that want to build data centers, because data centers, Bitcoin mining facilities, all of these things need massive amounts of water as well for the cooling of these facilities, because data centers and Bitcoin mining facilities generate massive amounts of heat. So they're going to need a massive amount of water. So instead of having to pump out water from underground, they can essentially take the dirty water that comes out of fracking, clean it, recycle it, and then sell it back to the fracking companies or to the companies that want to build data centers and Bitcoin mining facilities, which is, this is something super exciting that is expected to launch over the next 2 years. And so because of how TPL's business model works, where they really just own the land, they sit back and relax and collect royalties, they don't have to do any investment, they don't have to take on any risk, the company has 94% gross margins and 62% net margins, which is literally some of the highest margins you'll find in the entire market. And this is why the company is super high quality. And now one last thing I want to touch on before we get to the valuation part of the thesis is Just like Brookfield, a TPL is their management team is super aligned and super incentivized for the share price to do well, because a lot of their long-term incentive bonuses are heavily tied to long-term stock price appreciation and are heavily tied to cumulative free cash flow per share. So just like, it's very similar to Brookfield, the management team of TPL is heavily incentivized for the stock to do well. And finally, the last part of this thesis is the valuation, which is probably the hardest part of this thesis to stomach, because the stock is trading at 43 times forward earnings. And now I want to put this into context, because over the last 5 years, their average forward PE has been around 35 times. So even though it is trading at higher than their average forward price to earnings ratio, keep in mind that in 2021, 2022, and 2023, a lot of this company's revenue did come only from oil and gas, which means the company was a much lower quality stock than it is now. Because now, even when price of oil drops like it has been over the last year, the company was still able to grow their revenue thanks to their exploding water business. So in my opinion, the stock is a much more high quality stock in 2025 here at 43 times earnings than it was in 2021 and 2022, which is why I think it does deserve to trade at a premium valuation of 43 times forward earnings. And finally, the last stock on this list is Waste Management, ticker symbol WM. And we can see from this chart that the stock is down 10% from its all-time highs or from its current highs. And we can see that the average drawdown over the last 5 years has been around 10 to 15%, which is why I think the stock has either found a bottom already or is very close to finding a bottom. And Waste Management is one of those companies where, despite going through political admin changes, regulatory policy changes, pandemics, labor shortages, recessions, inflation, the stock has been super consistent, because no matter what's happening around the world, garbage still needs to be collected. And we can see here that the company has been able to grow their dividend by 8% per year over the last 10 years, and they've been able to buy back 12.7% of their market cap over the last 10 years, which is very good to see, and it shows us that management really cares about shareholder value. And now the next thing I want to talk about is that the company is heavily focusing on their medical waste segment, which is one of their fastest growing segments. And so they talk about here that the US has an aging population, they see a massive increase in chronic conditions, and they see a massive increase in US hospitality occupancy. And so this essentially means that because the US has an aging population and they're seeing hospital occupancy rates increasing, the company is heavily investing into their medical waste segment, which again is one of their fastest growing segments. And we can see here that it's expected to grow from $2.7 billion in 2023 to $3.8 billion in 2028. And overall, this company is expecting to grow revenues by 10% a year to $29 billion in revenue by 2027. And a lot of this growth is primarily driven by their healthcare solutions, like I said, their medical waste segment. So 10% growth in revenue from now until 2027. They're paying a 1.5% dividend, and they're buying back shares at 1.1% per year. And if you put that all together, 10% revenue growth, 1% share buybacks, and 1.5% dividends, I see at the very least, this is worst case scenario, I see 12.5% returns per year. And the reason why I think this is worst case scenario is because I think there's more room for growth when it comes to the valuation. So as we can see here, over the last 7 years, Waste Management has consistently traded at more and more of a premium. So in 2017, they were trading at around 10 times operating cash flow, but now they're trading at 15.5 times operating cash flow. So even though they're down 10% from their highs and they were trading at 18 and 19 times operating cash flow, we can see that the stock is consistently trading at more and more of a premium valuation. And this is because this company is a super high quality company. They're becoming more and more of a monopoly. They have close ties to the government, which means that, they have super high visibility when it comes to their revenue. And, it provides stability and safety to any portfolio, which is why I think companies like Waste Management are super important for anyone's portfolio. Even someone like me who heavily invests into tech, high beta, high growth companies, I think companies like Waste Management provide that stability. So when we do get a market crash eventually and my high growth, high beta tech stocks are down 50, 60, 70%, stocks like Waste Management will not be down that much. They'll be down 10, 15, 20%. And on some occasions, they'll even be up. So what I can do is I can sell out of those companies like Waste Management, take profits and rotate those profits into companies that have sold up 60, 70% and buy the dip on those companies, which is essentially why companies like Waste Management are super important to anyone's portfolio in my opinion. And so these were the top 3 stocks that I think are good buys today to protect yourself from massive downside risk. And so I hope you guys enjoyed this video. Don't forget to leave a like and make sure to subscribe. Peace.